Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Sunday, April 28th, 2024, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket 888, and I was going to take you on an update on some trades that I have been running into the maintenance mode now for a little while. I've recently kind of updated them to roll them out, and I just kind of want to share with you where I've been tracking, how much I've collected, where the trades are going, and just my thoughts on it. Also, this week there is quite a bit of earnings, and I wanted to call out a potential Starbucks earnings trade. Now, you're not going to have much time to react to this, so pretty much only the people that watch this on the day the video comes out will be able to take advantage of the Starbucks trade, but it is something that I think I'm going to add to my portfolio, so we'll keep you posted. But before we hop to that, I want to give a shout out to the Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this show is available in an audio-only format wherever you get your podcasts, so look for us there. If you can't find us, let us know, and we will get it there. But let's hop to this week's content. So like I mentioned, I have had quite a bit of trades out there. They're actually kind of taking up most of my buying power, and I don't have a lot of room to put new trades on. So I'm really kind of hoping some of these things will start to shut down soon. But some of them you'll see are not going so well, and they're just probably going to keep rolling here for a while. I just wanted to kind of take you through what that looks like, because a lot of times you can kind of keep rolling and collecting premium. And yes, it ties up your buying power, but you are kind of trickling in the capital in the background. And so you're not always losing money, even though the trades are very red and very against you. So I'll take you through some of these. Some of these are doing better than others, and I'll just kind of give you my thoughts on that just to see how I manage trades and what kind of stuff I go through on them. So first up is a futures trade. Now, futures trades are things I really like because of their capital efficiency. They collect a lot of premium. They don't take they do take a good bit of buying power, but relative to their notional value and their size, it's pretty decent type of leverage that you get on these trades. And so I tend to gravitate towards a couple staples. Natural gas is one of them. Russell Index is another. Wheat, sometimes S&P futures. I usually do the micros, because the minis are usually a little bit too big. But the trade I want to kind of look at here today is natural gas. And this is one that I thought I was going to hit pretty good back in February, and it just has yet to pan out. I mean, the chart on natural gas is really kind of going sideways and oscillating kind of up and down, up and down. And then this is interesting because it's futures, and futures actually expire monthly. So not only do the options expire, but the actual futures expire as well. And so that kind of makes for an interesting chart here, or an interesting collection. So I started this thing, and my original thesis was not my normal premium selling, but rather a bullish premium selling. And so I went very aggressive and sold a 40 delta put. And that happened to be at a $1.85 strike. I collected $1,000 for it. I really thought that was going to be a bang, bang. We were going to rally, collect my premium, and move on. But that is not what happened. Natural gas kind of tanked, and we kind of just started oscillating around. That March short put ended up expiring, and I had to settle it to cash. So I do trade the financial natural gases. There's two of them. One of them is the commodity, and one of them is financial. It says physical. The physical things settle to the actual product. So unless you want a lot of natural gas, don't trade that one. Trade the financial product where it settles to cash. And so these were in the money when the option and the futures expire. So basically they just kind of convert them over to cash, and you book the gain or loss depending on where you are. Because I was in the money, it was a loss. And so the contracts from month to month are not equally priced. So I have to pay attention to how much in the money I am, so that when I roll forward, I'm selling a put that is equidistant in the money. You can't keep the same strike because the underlying is not trading at the same price. That works in equities because the underlying is always trading at the same price from month to month. But in futures, because it's a different contract, it trades at a different price. And so you have to be cognizant of this. Otherwise, you'll kind of artificially oversell or undersell your roll. And so that's why you'll notice my strikes keep going up because I need to keep that same equidistant in the money when I go to sell the next month out. So in April, I had to bump up my strike to $1.95 based on where it was trading so I could keep the same amount of money in the money. That creates a wash there, so I'm not like losing any and I'm not gaining any. And now all I'm doing is picking up additional time premium. And so you can see I rolled that forward for 2370, collected more. Again, those did not pan out and they expired in the money. I had to settle them to cash, costing me $3,350. So again, I rolled forward into the May expiration. And again, I had to look at how deep was I in the money when I settled to cash, and I had to sell that same depth in the money when it picked the strike. And so I had to bump up to a 210 strike. I collected $3,240. You can see it was a little bit under the in the money. So, and ideally, that would have kind of been at least a wash, or I would have sold it for more premium than my settle to cash. I think I didn't quite get the in the money calculation correct, and I think volatility had also come down. So that's why I lost a little bit of money on that roll. So again, natural gas just kind of sputtering out, really failing to gain traction and take off. So May, this also settled to cash in the money again. This was most recently on April 25th, so costing me $4,620. Rolled it forward into June contract. And so again, I paid attention to how much in the money was I, so I could keep that same distance, rolled it forward, collecting $5,160. So if I add up all of the premium that I collected as well as all of the money that I lost when we were in the money and I was settling to cash, I am up a net $1,890, assuming that we can get above that 250 strike and expire out of the money. So I need a pretty good move in natural gas to get there. Now, the buying power kind of fluctuates. Currently, it was at $10,400 in buying power. And so if you take that, the return on capital dividing 1890 by 10,400 is roughly an 18% return on capital. So this, I'm going to keep kind of rolling it, see where it goes. Natural gas was looking like it might kind of break through that $2 mark, but it's really just kind of been banging against $2 and then dropping and then coming up and banging again and dropping. So we'll see. We'll keep you posted. I really don't want to book a big loss on this, but you know, it's really dragging on. This is abnormal. So a lot of times I'll roll for 1-2 times maybe, and then usually I get the price movement I'm looking for, and then I was paid for my patience in additional volatility that I collected. Now, the next one I want to look at is pretty much the worst trade that I have open right now, and it is Foot Locker. And the reason I say this is the worst trade is because it is stalled. It is at a point where I cannot really collect much money on this thing. I'm just kind of holding the shares, and it's really impacting my buying power. And this is one where, you know, potentially this is something I might want to consider cutting loose. So this originally started out as a short strangle with a put and a call around earnings at early March. They went way against me. I rolled to the next monthly out. And you know, the calls did expire worthless. Okay, wonderful. But this thing just kept nosediving. I rolled then to an April expiration, but I didn't make it to the April expiration. I couldn't roll. I was actually assigned 800 shares at the $30 strike price on April 11th. And this is where I look to turn around and sell calls against that to kind of wheel on out of here. However, because this thing is currently trading probably around $20 right now. It is just deep in the money, and the calls, $30 calls, are roughly like a 2 to 5 delta. So there's just not enough premium to sell that yet. And so I'm just kind of hanging on to these things, looking for some price rallying up closer to that $30 strike, ramping in some maybe volatility, and trying to sell calls. It's still a little ways for the next batch of earnings, but I'll keep an eye on this. But this one is completely stalled in my portfolio because it's too low below my strike to sell covered calls profitably, and it's just waiting for that. So I can't sell them to get a sign to get pulled out because we really need price appreciation there. I could sell and book a loss, but the chart is kind of looking like we might be in a bottoming form here. All right, next up is actually one that's going pretty well, Dollar General, and this is one that is just in this sweet spot of milking premium and milking premium again and again and again. So this thing has been going on since last summer, where I originally entered a strangle and sold that. Then, it dived and I waited. I got assigned these shares, only one contract. And then I started selling covered call against it. And I've been selling covered call since then. And you can see back in August, 268 was what I collected from the strangle. I rolled the put up to 145 because the put was 142 and that wasn't available when we nosedived and I needed to move it. So I got $3 there. Then I again sold earnings, a covered call at 145 for another $2. Sold a $3 covered call at 145 strike for February expiration. Because I was assigned these shares, I'm collecting dividends as we go along. So in January, I collected 60 cents a dividend per share. There's 100 shares there. Then again in February, I went out and put another covered call out there because these things just kept expiring worthless, letting me keep all the premium. Again, that expired worthless, and I was able to roll it out into 232 for another expiration in April. This was actually in the money, but I went ahead and rolled it forward again, forcing people to assign me for May expiration of 347. So I'm currently holding a covered call with May expiration, collected another dividend on April 16th. So all in all, I have collected $21.92 from all of these moves, which is, 100 times 100 shares, so $2,192. It's currently consuming a buying power of about $10,000 in my portfolio. And so we're sitting at about a 22% return on capital for this trade. And we're a little bit below my strike 142.07. So it's very likely that if we don't get big price appreciation here, I'll be able to get that 145 strike expiring worthless, and I'll sell another one. Hopefully we'll be sitting close at the money and be able to sell it for another $300, $400, maybe even $500 depending on volatility. All right, next up is Wolf. Now, Wolf is an earnings trade that I put on, did this one at a short strangle, did it at a $30 put and a $42.50 call. I did 4 of these contracts. It did not rally and actually broke through the bottom side of that $30 put. And I initially rolled that put out to a monthly expiration, all 4 of those contracts. Then that monthly didn't pan out and I rolled it forward to the next month. That didn't pan out. I rolled it forward to the next month. That didn't pan out and rolled it forward to the next month. So currently it's trading at 26.25. And I most recently rolled forward into May expiration on April 17th, collecting another $1.50 per share times 4. So all in all, you can see I've collected $2,768. Now, the really cool thing here is the buying power that this is holding up in my portfolio, because we're trading pretty robustly. The volatility has started to come down a little bit. It's only $2,200 of buying power. So that actually exceeds the premium I collected exceeds the buying power that I'm taking the hit. So the return on capital here is an impressive 126%. And I'm just going to keep rolling this thing, looking for that price to pop on through where I might finally be able to get above that $30 strike and expire worthless, or at least cash out for 50% of the premium that I've collected once we get there. But we'll see. We're almost to May expiration. We got about 2 more weeks, and the price has kind of been growing. So we have earnings coming up on Wolf, and so we'll see what happens as we move forward. All right. Next trade is Nordstrom. And this is an interesting one because I sold a lot of contracts on a strangle on Nordstrom and I was only partially assigned. So, originally this was March 5th. I sold an earnings strangle, 10 of these contracts at 65 cents. I ended up rolling those out, or at least the puts, because it went to the downside. I rolled the puts out to a monthly expiration. Those didn't hit. I was going to roll them forward to the next month. However, I was assigned early on 4 contracts. So I'm holding 400 Nordstrom shares where I was assigned at $20, which is where I had the strikes sold at for the put. I was able to roll the other 6 to April of the $20 put. Then, because I had 400 shares, I went ahead and sold 4 covered calls at the $20 strike for 90 cents a piece in March 21st. So neither of those things hit. So I took and rolled the 6 puts that I still had into May expiration, and then my covered call expired worthless. So I sold a brand new covered call, 4 of them, at 88 cents a strike. And so this is another one where the premium that I have collected has exceeded the buying power that this trade is holding up in my portfolio. So you can see I've collected $3,084 on Nordstrom. I am holding 400 shares. I have 6 put contracts. That is taking up a buying power of 2,200 shares, which sits me at a 140% return on capital because I've actually collected more money than the impact to the buying power. So that's where my portfolio sits of these open trades. We've covered these in the past. This is just showing you that they're still there. I'm still rolling them. I'm still managing them. I'm still collecting premium, albeit Foot Locker is stalled. So that one is just kind of in a holding pattern and really the worst trade that I have in my portfolio right now. Natural gas is probably the second worst because of the amount of buying power that it's consuming and the fact that it's just not going anywhere. The rest of them, I'm not too sad about them. It would be cool if I could close them out and move to some other trades or some other earnings, but I am still collecting money as we go, and it's not that terrible. So you can see, even though things work against you, you can still collect premium. You can still move in the positive direction, albeit maybe not as big gains, but all this is going to add up, and it's going to grow my portfolio slowly over time. And so the next thing I want to call out is this week there's quite a bit of earnings, but one particular earnings trade has really struck me, and I almost took this trade the last round of earnings, and I think I'm going to take it this time. So it's Starbucks. They actually announced on April 30th. I'm planning to open up a strangle on probably the 29th, although I believe they are after the bell on the 30th. So that's Tuesday after the market closes. So you could open this on Tuesday if you wanted to. And so I'm looking at probably a 20 delta strangle. The volatility is pretty much pretty extended. I think it's around a 65% historical volatility. Not uber extended, but pretty decent extended. The trading range and the chart really looks like it's kind of at a midpoint. That's why I kind of am looking at maybe a strangle here. And so the 20 delta strangle is probably going to put me around an $83 put and a $95 call. Adding those together, they're about 80 to 85 cents a piece. We'll see when the market opens where things are priced, where does the Starbucks trading at. But I'm looking at probably doing 2 of those, assuming I can get in for about $1.60 for a strangle, maybe up to $1.65. That should put me around a $320 to $330 total premium collected. It'll take about $2,800 in buying power, which is approximately a 12% return on capital. So pretty good. And I do like the fact that we're really in an extended volatility. So I'm really going to look for that volatility contraction. And Starbucks, I'm actually a little bit bullish overall. And so I wouldn't be too sad if this thing, maybe didn't break through the call side. I can close the call out, or maybe the call expires worthless. It still is in a bit of a downtrend. So it's not kind of swinging up, which is why I'm not as nervous on the call. But we'll really see how this pans out. But this is a potential earnings trade that I am looking at this week of that extended volatility, looking for a volatility contraction. And that brings us to the end of this week's brief episode. Like I said, sometimes trading is boring, and I want to make sure that I'm showing you the good, the bad, and the ugly. And right now, I'm kind of in a holding pattern as I'm rolling and managing my open trades. Don't really have enough buying power to open up too many new things. I am looking at opening up the Starbucks' earnings because I have a little bit of buying power there. This buying power all fluctuates all the time. And so I put in my return on capital, the buying power as it sits today. Now, this thing can kind of grow and shrink, which is why on my portfolio, I really try to keep a good chunk of my buying power free. So I really only ever try to utilize about 50% of my buying power. When volatility gets real high and overextended, I'll kind of ramp up that buying power usage to maybe a 60, 65, maybe even as high as 70% utilization, because I'm looking for that volatility contraction. I want to sell that premium when it's extended. But when you're sitting a little bit more normal, you want to keep that buying power free because you'll get some expansion and contraction through the trades and the price movement of the underlying. And you don't want to get squeezed out on margin calls or things like that. So you want to keep some cushion out there. And one of the things I did learn, I can take a lot of this extra cash that's sitting there, and you can buy U.S. Treasuries, and that really doesn't impact your buying power capability. It just drops it maybe 10, 20 bucks of buying power. So you can get your 2-week Treasury yields, which are pretty decent right now. So the cash isn't just completely on the sidelines earning you nothing. You can set it out there in Treasuries, which is one of the things that I do. So good luck out there. We're really in the heart of earnings seasons, and so there's quite a bit of earnings coming up. I encourage you to look out there, try to look and see what your favorite stocks are as far as volatility goes. When are their earnings announcements? Because earnings are a great binary event to get some big price action and price movement, to get some quick swing trades and price level trades off. It's really an accelerant to the price action, as Viper and I have covered multiple times on this show. And so going into it is like a rapid fast forward of the price action that is to be. So good luck out there. I hope you find something interesting to trade. And remember, think outside the block.